Hi, welcome back. In the last video, we observed how equity infusion impacted our cash and how balance sheet became the premier to start our business. In this video, we'll go through evolution of accounts receivable. As of now, I have applied the basic assumptions of revenue derivation, costs as well as taxes directly leading to a PAT. These numbers are based on assumptions. In terms of revenue forecasting, just to give you the basic idea right now, at a granular level, revenue is price multiplied by volume. Let's take the example of movie exhibition, right? When you enter to watch a movie, let's say PVR or Inox, the footfalls ourselves as a customer are the volume, and the price of 250 rupees or 350 rupees they charge is the price they charge. So if you are quite keen to observe to what extent PVR makes money per screen, you just need to apply for a gross price multiplied by revenue, and that's how you try to conduct the revenue forecasting. Now, accounts receivables, it is something that we as a business are supposed to receive the money, and we have already served the customers. Just to give you the example over here, let's say some students are requesting us as a B school that they will be paying the fees later on. So how we will give an accounting impact is the objective of this video. To start with, we are supposed to receive the money and we have already served them. Thus, it's an asset. I'm just using a basic number of 150 as an assumption. This means we will be receiving this money in the future, right? But we'll be recognize this as part of revenue because it's an accrual based accounting and not cash based accounting. So as a part of accounts receivable, that will get recognized in our current T1 revenue, and this is part of our working capital. So working capital is linked with the changes in cash flows. So I'll incorporate another line item of changes in accounts receivables. Since this is an asset, and as asset goes up, cash goes down, we have not received this cash as of now, so it is considered as an outflow. And this is how it impacts our cash flow statement. As the next step, we'll link balance sheet and cash flows. Net income is linked with PAT of T1. Accounts receivable changes are already linked. Cash flow from operations is the gap of net income and accounts receivable. So net, this is the real cash in our hand available right now in our bank balance. There are no impact from other investing or financing activities. The net change remains of the same, 816. I have linked beginning cash balance of T0, and currently our ending cash balance is 916 in our bank account. This 916 I have linked from the end of cash balance T1. Total assets with us is 1066. The equity is T0 equity plus T1 net income, and as we can see, this is how balance sheet balance is. Adding more to this, the question arises that what if our receivables are paid back to us? Going back to our initial thoughts, we have already recorded our receivables, but when it is paid back to us, we will not change the amount that we have already recognized in income statement. So right now I'll hard code this number of 150, and when we are paid, let's say 50 back, so this will be 100. Now you observe that this 50 has already changed because of our linking to increase in 50. So initially it was 150, it was 916. We have received 50 back. So that cash net changes with our inflow of cash received. So as receivables or assets goes down, cash goes up. This how our basics or the fundamentals of financial accounting works. And always the balance sheet balances in financial modeling, in valuation, if you link the particulars correctly, your balance sheet is bound to match. So that is that. Thank you for watching. In the next video we will see how accounts payables play a crucial role in influencing the numbers across the financial statements.